the first thing that we are going to catch up here is with regard to break-even point, that is BEP. Okay. The question comes, what is break-even point? Very layman's language, the answer is break-even point is at that point where company makes no profit, no loss. Okay. This is what break-even point generally known as. I'd say that this definition is a wrong definition. Although technically you could be correct, but you are wrong. Reason for that is, if you do not put up a company and sit at home, you will be doing no profit, no loss. Doesn't mean that you are in break-even point. Break-even point means that point in sales which you have to earn in order to cover your fixed cost. That is the definition of a break-even point. Okay. So simply saying that if I am producing a product, let us say the product is a bottle. I'm producing a bottle. Okay. And the cost of producing that bottle, okay, variable cost of producing that bottle is, let us say, 80 rupees. Okay. And fixed cost, okay, of producing this bottle is, let us say, 25 rupees. Okay. And let us say the selling price, okay, is 75 rupees. Okay. In this case, if you look at these two scenarios, that is the variable cost and the selling price, my selling price is not even covering my variable cost. In this situation, okay, calculation of break-even point, forget it. Okay, doing the business itself is not possible because I'm having something called as operating loss. Okay, if your core finance or core business activity is not giving you profit, then it is not worth doing the business. Okay. Just like saying that there could be a business where there is a good operating profit, but because they have taken a lot of loans, they pay a lot of interest, which is a lot of indirect cost. And because of that, they are coming into losses. In that case, the business is runnable. Okay. So you can get out of the debt someday and you can actually make profit. Okay. So that kind of understanding is required. But here, the problem is there is no operating profit only, there are operating loss. So there is no question of, calculating any break-even point over here. Okay. Next. So break-even point is that point. So every product is there. In our current product, there was bottle. Okay. Its total cost will have two different dimensions. One is variable cost, one is fixed cost. Okay. Variable cost will be there, fixed cost will be there. Okay. And there will be a selling price. Okay. Now, from the selling price, when you minus the variable cost, you get this resultant called as contribution. Okay. Now, this contribution, okay, is nothing but what remains after you minus the variable cost from the selling price. Okay. So this contribution is called as contribution because it contributes towards two things. One is fixed cost. Second one is something called as profit. Okay. So if a selling price is, let us say, 100, okay, per unit selling price is 100. If variable cost is, let us say, 60, then my contribution will be how much? 40. This contribution will have to cover my fixed cost and profit. Let us say fixed cost per unit is 30 rupees. Okay, which means the balancing figure will be profit, that is 10. Okay. Here, I have to make sure that initially when I run the business, okay, let us say I put up one plant. Okay, I put up one plant or factory. Okay, I put up couple of machineries. Okay, and the total fixed cost came up to, let us say, 5 lakh rupees. Total fixed cost came up to this. And then once you have put up this setup, okay, for this setup, you don't have to spend anything extra. Once you have put up this machine, for this machine, you don't have to spend anything extra. Only the thing you will be doing is, probably servicing the machine or cleaning the machine or setting up the machine or something like that. But you don't need a new machine, which means this kind of a big money you won't be spending. But the problem is not that. The problem is what? Then you calculate something called as contribution without considering the cost involved over here. Remember this, without considering the cost of the setting up this entire factory, I calculate something called as contribution. That is, sales. That is exactly what I'm receiving. Let us say I'm getting 1,000 rupees per unit, okay, as sales revenue. And I will only consider variable cost. That is not the cost of this setup, not the cost of this machine. I will only consider the cost of the things that I'm putting in order to get the output, such as raw material, such as labor, such as variable expenses, etc., etc. Okay. So all those variable things I will take out first. Okay, and that will come up to 600 rupees, which means 400 rupees remain. I will call it as contribution. Now this contribution's job, the first job of this contribution is not to give profit to its owners. The first job of this contribution is to recover this 5 lakh rupees, which you have put up in the beginning. So what do we do here? We have to see how many units I have to sell in order to make this 5 lakh rupees. Okay. If you do 1 unit, 400 contribution remains. Forget about 600. 600 is gone. In inputs only it has gone. Raw material, labor, it has gone. 400 remains. How many of these units I have to sell in order to make this 5 lakh rupees? It's a very simple thing to do. That is 5 lakh divided by 400. How much is 5 lakh divided by 400? 1,250 units.
1,250 units to break even.
Okay. So this is nothing but my break-even point. Okay. Which means in order to cover my entire fixed cost, variable cost though I'm covering only. When I get to the contribution, variable cost is already minused, which means variable cost I'm already considering. Okay. So here the only issue is of the fixed cost, and fixed cost I will have to cover, and I need to produce and sell. Remember this, produce and sell 1,250 units in order to get to the break-even point. But break-even point can also be mentioned in terms of units or in terms of value. Okay. Value, how to get to the value? Once you get the units, it's very easy. Multiply it with the selling price, you will get the value. Okay. But there is also a formula way through which we can calculate this break-even point in value. That is nothing but fixed cost on the numerator will remain the same, but denominator will become the contribution to sales ratio, or we used to know it as PV ratio. Okay. In the terminology of ACCA, this book, they have used the word contribution to sales ratio, which is a good thing, because when you say PV ratio, you might not even know the formula. But when you say contribution upon sales, you know that it is contribution upon sales. So it's the easier name. Okay. And so the C bar S ratio is the ratio that we'll be using, as a denominator in order to get to the value. Okay. It's as simple as that. The break-even point is calculated this way. Okay. So basically, what does this problem propagate? Okay. Let us read it. And after reading, we'll understand it. The following data relates to the product PQ. Okay. The selling price per product is 25 per unit, whereas variable cost is 20 per unit. Fixed costs are 50,000. Okay. And what we have to calculate, we have to calculate the number of units that must be made, okay, and sold in order to break even. Okay. Break even point, what is the formula? The formula for break even point is fixed cost divided by contribution per unit. They have clearly asked us in units, number of units that must be made. So the denominator is correct, that is contribution per unit. Okay. So fixed cost is how much? 50,000. So what is the contribution? Selling price is 25, variable cost is 20. We minus that, we'll get contribution. I use that. Okay. And I get to the break-even point. The break-even point is 10,000 units. Okay. Next important thing is, next calculation is with regard to the calculate the level of activity that is required to generate a profit of 40,000. I would like to call this as required sales to earn desired profit. Okay. Now, why are we calculating break-even point? In order to make sure that we will cover our fixed cost, isn't it? That is our major objective. Okay, we have to cover the fixed cost. Now, when you say that I want to cover my fixed cost also, I want to get profit also, even that profit becomes a commitment, isn't it? Just like the fixed cost. So nothing but add that to the fixed cost. Whatever profit that you want on the numerator, add it to the fixed cost. Just like how you want to recover the fixed cost, you will also recover that profit. As easy as that. So only numerator will change. That is, fixed cost will be there over here. Okay. We will add what? Required profit also. Okay. And then we will divide it by the same thing. That is contribution per unit. Okay. So how does that work? 40,000 required profit plus fixed cost is 50,000 divided by contribution per unit. That is 5. How much? 18,000. Done. 18,000. Okay. Next, we have to calculate the next thing. Okay. That is, company budgets to sell 13,000 units of product PQ. Okay. Calculate the margin of safety. Now I have to tell you what margin of safety is. Okay. So let me put this understanding. Okay. Once your break-even point is reached, you enter an area called as margin of safety. That is where you start earning actual profits. Okay. Margin of safety, as the name suggests itself. See, if I have to divide the total sales into two parts, one part will be break-even sales. That is until you reach the break-even point. And after you reach the break-even point, whatever sales comes, that is called as margin of safety. Okay. In terms of the terminology. So margin of safety is what? Budgeted level minus break-even level of activity. Okay, that is budgeted sales minus break-even sales, or budgeted units minus break-even units. When you do that, you get something called as margin of safety. Okay, so how do I calculate the margin of safety percentage? Margin of safety percentage is equal to budgeted sales, that is total sales. I can write it as total sales here, minus the break-even sales. What remains is what? Margin of safety divided by budgeted sales. That is how much of the percentage of the sales is margin of safety is the calculation over here. If you just want to calculate margin of safety, this is all it. Only the numerator. You calculate only the numerator, you will get margin of safety in numbers. Okay. But you want to calculate margin of safety percentage. I need not say that BEP plus MOS, that is margin of safety, should be 100%. That is nothing but my total sales. 100% of my sales is divided into break-even sales and margin of safety. Okay. So, any doubts over here?
No.
No doubts?
No.
Fourth one. Okay, we'll calculate this. We have not calculated this. So tell me, what is the margin of safety? Margin of safety is equal to, if the company budgets to sell 13,000 units, and we have already calculated the BEP point, that is 10,000 units. In the first A, we calculated BEP as 10,000 units. Okay.
Yeah.
Margin of safety, nothing but total sales minus BEP sales. How much it will be? 13,000 minus 10,000. That is 3,000 units. 3,000 units is my margin of safety in units. If I want margin of safety in value, what will I do? Multiply it with the selling price.
Sale price.
Okay. So, sales price. What is the sales price per unit? Sales price per unit is 25.
20.
Okay. How much it will be? 3,000 multiplied by 25 is 75,000. Okay. Then, as a percentage, if you want to calculate, it is nothing but totally I'm selling 13,000 units. Margin of safety, I'm selling 3,000 units. So, percentage will be nothing but
3,000 by 30 to 13,000.
3,000 into 25 divided by 13,000 into 25 into 100. Or you can just do 3,000 divided by 13,000 into 100.
Yes.
How much did you get?
23%.
20. Done.
Yes.
Next, calculate the contribution to sales ratio for product PQ. Contribution to sales ratio is contribution divided by sales. That is 5 divided by 25. How much it is? 5 divided by 25 is 20%.
1 by 5, 20%.
Done. Calculate the break-even point again, this time expressed in terms of sales revenue. I told you directly I can calculate fixed cost divided by PV ratio, that is CS ratio. If I do, I'll get it. Or I can do the same thing. How many units was my break-even units? 10,000 units multiplied by the selling price, that is 25. You get it immediately, 2,50,000. Or else I can do this also. Fixed cost is how much? 50,000 divided by PV ratio is 20%. Is again 2,50,000.
Yes. Yes.
Yeah. Next, calculate the sales revenue that is required to generate a profit of 40,000. Okay, it's a same, same wine, different glass. Okay, so 40,000 is the required profit. 50,000 is the total fixed cost. CS ratio is 20%. That is 4,50,000. Yes.
It was asked earlier also same, right? 40,000 to generate 40,000.
That time they asked sales revenue, not sales revenue, sales units. It was asked in units. You'll just look at the denominator. Here it is CS ratio. There it was contribution per unit.